welcome to the next session. I'm super delighted you are still here with me today. I'm going to share with you the most stable property strategy I know of that lots of investors, lots of property owners invest in because it's stable, steady, and there is lots of capital appreciation in this sort of strategy. So it is called family let, single let. Some people call it buy to let, where you buy the property, right? This is where an investor purchases a house, usually 2 to 3 bedrooms, and let it out to a family on one tenancy. This is a stable property investment strategy and it's less risky with lower return. But because the property will be appreciating in value, you'll be making cash flow as well as capital appreciation. This is because why it's so easy to manage these sort of properties is because the whole house is let to one family, not on a room by room basis. Income stream is also steady, no hassle to deal with different type of tenant, and you've only got one tenant to look after. And also we have less tenants turnover in this type of properties as well, because when families move in, sometimes they stay longer, very, very long. We've got a property that our tenants have been there for over 5 years and they've never thought about moving out. So again, this is the stability investors want and less stress. It is suitable for an investor. As I said, it's not a job. It can be easily managed by yourself, for example, or a letting agent or an estate agency. So, but now there are key rules to buying these properties to ensure that they are lettable. It's not about buying the properties, it's about buying the properties where you need to buy them, right? I'll talk about 4 of these golden rules. There are more, but again, it is out of scope for this course. And again, I'll talk you about 4 of them. One is location. Location is very important. The location you purchase your property investment, right? Get a property half the cost of one in the big city. For example, instead of buying a property in Cardiff, you could buy one in Newport, you could buy one in Swansea. The prices are different. Usually rent doesn't vary that much, and house price usually go up the same anyways. So instead of buying in Birmingham, you can buy in Coventry, for example. Capacity. I usually buy a minimum of 3 or 4 bedroom house, not apartment. The reason why I don't like leasehold properties, and there are always service charges, there are always hidden charges, they're just sometimes, it doesn't do me favor. And also, if the family expand and move in because they'll be looking for gardens, they would like to have a gardens, etc., etc. That's the reason why they're investing in an apartment. And the other reason, the other requirement is capital growth. North of England, property growth average increased annually by 7.5% in the past 8 years, according to the UK House Price Index. Wales average annual price change of a property ending of April 2019 was about 6.7%, right? So again, this is very good looking at it, because if it increases that much, imagine how much it would increase by in the next 10 years. To boost capital growth, your investment property needs to be very close to a good secondary school, good transport link, good road network, in a town, near a town center. This allows good capital growth over time, because these are the places where people want to live, very close to a shopping center, very close to a big supermarket, and it's walking distance to town center. I usually aim for a minimum of 5% capital growth. So obviously that needs to be taken into account. So I'm going to switch the screen now and talk to you about the other requirement, which is cash flow. I'll rather demonstrate the figures in this sort of situation so you can see exactly what the cash flow needs to be, right? Okay, let's go on to the screen. Hello and welcome to this video. To make our deal stack up, we also need to talk about the cash flow. The cash flow tells us whether the deal that we're looking for is profitable or not. As promised, I'm going to talk to you about how we calculate our cash flow. We need to make sure our cash flow is correct. Now let's assume in this calculation we're not taking into account any of the tax changes. We're assuming as how it was calculated in in 2016-2017 financial year, so that we can make sense of how our deal is going to look like, whether it is profitable or not. So let's go through the calculation. Say, for example, we've now acquired a property in Birmingham for 100,000, and we are now going to rent it out for 600. We've made our research, and we think we are able to rent this property out for 675. So now we need to go back in our data to analyze and see if this calculation makes sense, and whether we would generate positive cash flow for our investment. So what we would do, we would go in, we would write, we would do rental income. We've assumed the rental income would be £675. So we put that there. And then we've also assumed our mortgage roughly about 4 to 5% interest that we pay in our mortgage in a yearly basis. So we assume a monthly interest rate of £375. And insurance also, we'd estimate our insurance. This is building insurance, not content insurance, because our tenants are responsible to pay for whatever contents they have in their property. So we can assume insurance would cost us about £20. And again, maintenance is a very difficult one to take into account. But what we normally do in my company is to assume we would spend 10% of our monthly income in any maintenance work. So what we would do, we would then take 10% of our gross rental income and times that by 10%. That gives us £67.50. So we're going to put that aside, assuming that we would be having maintenance work. It doesn't mean that you would actually incur this cost in this specific month, but it might be the third or fourth month you would have a bigger expense that actually would have included the amount we've estimated here. And roughly, we also estimate our agency fees to be about 10% of our gross rental income. So again, we would do our gross rental income, we would times that by 10%. Again, that gives us £67.50. So what we would then do, we would add all our expenses, all these expenses, we add them all up. We have a total. We would add all the expenses up, and then that would give us a grand total. So what we then do to know whether we are in a positive or negative, we need to actually minus the £530 from our gross income. As you can see here, it tells us we are making £145 a month. Again, we're assuming this is going to be a positive cash flow. So if it hits this criteria, and again, it's a telltale sign to say if we buy this property, it will generate us a positive cash flow. Right? It tells us we are making £145 a month. I further like to reanalyze just to make sure we're making profitable income. And then also, I would like to analyze how much net income I would make throughout the year. And the way I analyze this also, I take a buffer into consideration. Instead of timesing my monthly net cash flow by 12 months, I will times my net cash flow by 11 months, assuming that my tenant may not be able to pay me the full rent for 12 months in a row. So again, I'm bringing that buffer in there to make sure our investments stack up. So what I will do 11 months here times net cash flow. So if we do that, it would be equals to 145, which is our monthly net cash flow by 11 months. So that gives us a whopping £1,595 a year. So this would be our net cash flow. However, my rules of thumb is my yearly cash flow should be more than my gross rental income. If it is less than my gross rental income, I will always reject even if the property meets all the other golden rules, because the cash flow is one of the most important thing in your investment. You do not want to be subsidizing your property. You want the property to be able to look after itself. Say for example, we had our rental income calculation wrong. After nearly when we were about to buy the property, we went back again and did another research. We realized our rental income would be £550. In that case, we would be making £45 a month profit. So looking at this, if we multiply the £45 by 11 months, this is our net cash flow by 11 months. As you can see, it generates £495 profit per year. As you can see here, even if it is £5 out, I will reject the deal because I do not want to subsidize my properties. As you can see here, the monthly rental income is more than our net yearly cash flow, which is £495. So we are generating £550 a month, right? And if we multiply our net cash flow by 11 months, we are only making £495, which is less than our monthly rental income. In that case, I will reject the deal, even the deal hits all the other criteria, even if it passes all the other criteria, because the cash flow is very, very important for you, your investment, and your property itself. Because the last thing you want is to using your savings to subsidize a property you've bought that could have actually been generating you income. So any total monthly income that is less than the actual one monthly income, we reject. The yearly income, the yearly net cash flow, the yearly net cash flow should be more than your monthly rental income. Again, this is just some of the key rules to get you diamond property. If you join us in the advanced course, we will go through all the golden rules, all the rules I use or I have used, I am still using to buy my properties. So I cannot emphasize enough how important it is to join us in our advanced course. I will go through them all. You've got the chance to ask me any questions, and I can also demonstrate how to actually use the rules to get the property. Thanks very much for listening. I look forward to sharing next video.